Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Evidence points to a big deterioration in the number of stocks that are participating in this rally. That's as the S&P 500 struggles at a major line of resistance here, this price channel that I believe defines the trend in this bear market. I'm also going to show you, based on the current market data that we got this week, is likely to head down in the next few months, and evidence tells us this could actually happen by September of this year. So I hope you guys are going to enjoy this one. Of course, take everything that I say with a grain of salt. All the claims that I make in this video are backed up by the research that we provide at gameoftrades.net, but make sure to do your own research. Now, without further ado, let's get right into it. So last week, the S&P 500 tagged the 50% retracement level of this bear market. You can see this rally that we've had recently goes up to the 50% retracement of this move. That means we've retraced 50% of the bear market that we saw throughout 2022. Now, if you take a look at prior bear markets, this is absolutely within expectations. You can see the same thing happen in the 70s bear market. We discussed this in a video recently with this move up in 1969, retracing 50% of this move down that we saw in the prior year. But now the market expectations that we're seeing are telling a completely different story to what we had throughout 2022. So if we take a look at the Fed funds futures curve, this is what it looks like, the orange one being the most recent market expectations. You can see the futures market currently expects the Federal Reserve to begin cutting rates in the very near future, as soon as potentially July of 2023. Now, of course, I don't need to remind you that that's a completely different story to what we had in 2022, where the markets were anticipating a massive rise in interest rates. So many people are pointing to that and saying, well, the bear market is behind us. Now that the Fed is going to begin cutting rates, we can expect the stock market to break out of this bear market trend. But of course, that's not always true. If we take a look at that same example in the 1970s, the bear market rally occurred right here as the Federal Reserve was about to begin cutting rates. And so while the first part of the bear market was while the Fed was tightening monetary policy, the second part of the bear market was while the Fed was cutting rates. But if you take a look at 1995, for example, here you had a very volatile period here in 1994 as the Federal Reserve was raising its federal funds rate. That put a lot of pressure on market valuations throughout that period. And once the Fed began to cut rates here in 1995, look at what happened to the stock market. It went on an absolute melt up. So depending on what narrative people have, you're going to see them cherry pick episodes that fit their narrative. That's why we like to take a look at these problems with a very quantitative, unbiased approach and just give us the odds of being right or wrong about something in the market. And that's what this chart is. You can see there's 3 sections here. What happens to stocks and treasury bonds when the Fed pauses? What happens to stocks and treasury bonds when the Fed cuts? And there's a recession within the next 6 months that plays out, which, by the way, is our base case scenario. That's what we expect to happen. You can see, of course, when there's a recession that happens within the next 6 months, stocks go down heavily. But you can also see that stocks actually don't perform very well when the Fed cuts and there's no recession within the next 6 months. And you actually see bonds outperform stocks in that type of environment. Now, the reason that happens, most of the time they're going to be cutting rates because you're seeing the economy deteriorate, and that's forcing the Fed to cut interest rates. And so if you're seeing economic deterioration, well, the stock market is unlikely performing extremely well. There's other assets in these types of environments that perform a lot better with a lot more attractive risk reward that are going to let you raise your odds of appreciating your capital in this type of environment where you're seeing the Federal Reserve cut because you're heading into a recession or because we might be heading into a recession. Of course, make sure to check out our website if you want to actively follow these types of trades. So what the Fed funds curve is currently telling us right now is that the market expects that the Fed is going to need to cut rates in response to an economy that is deteriorating. And that could actually happen in the next few months. You can see here as soon as July, September of 2023, the market expects that the Fed is going to need to respond to a weakening of the economy. And as I'm going to show you in just a moment, we are seeing a big deterioration right now in the number of stocks that are participating in this rally. So that adds weight to this idea that there are some concerning things that are brewing underneath the surface despite this optimism, risk-on move that we're seeing on the market right now. But before we take a look at that, let's address the bullish scenario. What would need to happen for stocks to continue their run higher right now and go on a melt up? That scenario is this one right here. It's the Fed pauses and you don't see a recession. Now that might seem confusing because why would a Fed pause be more bullish than a Fed cut? The reason that happens is they don't necessarily occur when the economy is deteriorating. So in these scenarios, and 2019 is a great example of that, the Fed is pretty happy with how far it was able to climb the interest rate, and they're seeing some signs that the economy is weakening because of the rate hike. And so they pause monetary policy to just see where things are going. And that usually happens in an environment where you've got very low inflation, and the Fed is not very concerned about that. And you can see in 2019, you had the Fed pause monetary policy here in January of 2019. Now look at what happened to the stock market. It went on an absolute massive run until, of course, global shutdowns triggered a recession, which retraced the entire rally that we saw throughout that period. So that's really the bullish scenario for the stock market, that we're not really heading into a recession right now, that the Fed is basically just going to keep rates at current levels for a while, see where things go. And over the next few months, you see huge evidence that inflation is coming back down and that the economy is holding up. And so you're going to see the stock market rally in response to those developments. And right now, I'll be very honest with you, that is the furthest away from our base case scenario. If you take a look at leading economic indicators, they are at levels that have always been associated with recessions. If you go back to the 1960s, every time leading economic indicators go down to this level, you have a recession. So we're much more likely to be in this scenario where stocks actually go down than these other two scenarios. And yes, inflation is coming down quite rapidly, but if you take a look at the ISM prices paid survey, that essentially tells us how much manufacturers are actually paying to produce goods, well, you can see that's been turning back up recently. So yes, inflation, headline inflation is coming down because oil has been very weak recently, but you can see underneath the surface, we could be seeing some inflationary pressures rise again. A lot of these bottoms in ISM prices paid have occurred around bottoms in headline inflation. So even the inflation story might not be completely behind us. We were very bearish on inflation back in June because energy prices were extremely overbought, commodities were extremely overbought, but now it could become a different story here. And now finally, I want to show you the weakness in the participation that we're currently seeing in the market. This is a huge signal that we're seeing right now. This is an indicator I absolutely love and respect. You can see we were watching this throughout the end of 2021 as the market was moving higher and breadth was showing a lot of weakness here. Stocks making new all-time highs and market breadth telling us only 70% of stocks were actually above their 200-day moving average. That's an extremely worrying signal in the market. And we're actually seeing something very similar right now. Yes, stocks are not at all-time highs, but the S&P 500 is trading well above its 200-day moving average right now. But you take a look at the number of stocks here, this orange line, that are above their 200-day moving average, and we're under 50%, so less than 50% of stocks are trading above their 200-day moving average. And you can see even more recently right here, as we've had this kind of consolidation in the market, right below resistance, we've seen an even larger deterioration in market breadth. So unless we see a material change in the macro environment right now that could really fuel a broad, healthy recovery like we saw here throughout 2020 that fueled the rest of the run throughout 2021. Unless we see that, this remains a very unconvincing rally that is stalling at resistance, stalling at a typical bear market retracement level right before a recession is playing out. I hope you guys enjoyed this video. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.